to get the interest rate data from the website? No? Okay. So yeah, last Tuesday we talked about how to get real world data from the website. If you have a question and go back to watch the lectures I posted on Blackboard, so it will lead you step by step to get the data. Okay. It will help you, to calculate what is real interest rate, what is default risk premium, what is maturity risk premium of the United States. Okay, so now we learn the U.S. financial systems. U.S. financial systems define financial securities and explain the function of financial intermediaries, the function of international financial intermediaries. Identify the different financial market. Okay. Describe the securities traded in money market and the capital market. Okay, that's the learning objectives. So you can see today we're gonna cover actually the first 5 lectures, all those 5. And the last time we only talked about the determinants of nominal interest rate. Okay, that part is a little bit difficult. But even we have 5 learning objectives today, okay, it's much easier than we did last time. Okay. And now we skipped the financial crisis last time we talked about. And so we start with the financial system. Okay, financial system. Okay, so let's see. The purpose of the financial system is to bring together individuals, business, and government entities. All those 3 are called economic units that generate and spin form. Individuals, business, government entities. All of them are called economic units. So when you study, let's say, economics, okay? You think about economics, you talk about the business. You talk about the government, okay? So in finance, it's the same. If we talk about the finance in business, that's the course we take. Right now it's called corporate finance. So you took corporate finance because this part of finance are related to business. Okay, related to business. Individual finance is called personal finance. I planning to have personal finance for different majors of students. So that's on the plan. So we pretty much later we're gonna have another personal finance class for all the college students in different majors. And for government entities, because another course is called public finance. So, and you, if you're interested, you might find a book or lectures about public finance. Okay, it's a little bit different. Okay, each area is different. As the first thing we're talking about, if you study like a corporate finance, I would suggest you to get to think about CFA. Okay, certified financial analyst. Okay, you go to the website, you know, is CFA. So let's see, we have so you can go to cfainstitute.org and to take that CFA exam. Okay, this is the official website for CFA Institute. Okay, if you wanted to do that, okay, you take a CFA exam. Okay, so most of the country, it's like an international certified. Most of the country recognize the CFA certificate as a master level. Okay, even you got better pay, much better pay than you got a graduate degree. So on average, is the CFA, they paid about 150,000. That's per year. So not on average. So that means you just get started, you pay 150. All about you have 5 or 10 years experience. Okay, if you work in a investment bank or big company as a CFA, after 5 or 10 years, your salary easily to go 250, 500,000. Okay, so that's the benefit of the value of CFA. If you, I just wanted to think about, okay, consider that. Okay, other than this, and if you do personal finance, okay, personal finance, you have a certified financial planner, okay, CFP exam or CFP certification. This is called certified financial planner. They do personal finance. Okay, so you have a CFP. Okay, it's different from CPA. So most of the students, they heard of that, how to get a CPA, but they didn't heard of what CFA, what is a CFP. Okay. So it's very good and to learn the different type of certification in finance. That's why, you know, and if you have students, that's why the major, which major you take is important. The different major give you different pay. Okay, now we talk about is the financial system. So the financial system, all these 3 different types of entities, we call them economic units. Okay, the economic units. So economic units could be surplus economic units. Surplus economic units is they have money. Okay, they are savers and they can lend their money. Surplus. What about the deficit economic units? Deficit economic units, they need money. they are borrowers. Okay, they are borrowers, and the surplus economic units, they are savers. Okay, deficit economic units need money. Surplus economic units provide money. Okay, so you might have a question, okay, this party, they have money, this party, they need money. What about they just meet together? They meet each other, right? You can get all the money you need. Yeah, it seems like a pretty logical, because that's a very good idea. You know, they just meet each other, get the money, what you want, and then it's done. But in reality, no. Okay, they cannot do the transaction, or they make an agreement doing that directly. What they do is they are going to go to the third parties. Both sides go to the third parties is called financial intermediaries. Okay, financial intermediaries will help to facilitate this process. Help to proceed this process. Okay, you need money. Okay, don't come to me. Even I have money. Okay, I'm not going to do business with you. Go to the third party, financial intermediaries. Okay, later on we talk about the different types of financial intermediaries, the banks, the credit unions, saving loans, insurance companies. Don't come to me. Okay? Come to the bank. So there are great benefits of doing that. Okay, the first, I don't trust you. I don't have enough money. I don't know the details. So everything you need to know goes to the third party. Okay, so financial markets are classified according to the characteristics of participants and the securities involved. There are two different types of market. So one is primary market, and another one is secondary market. So you have primary market. So what is a primary market? The primary market is issue new securities to raise capital. Okay, primary, that's the first time. Or issuing new securities. We call this one is a primary market. Primary market for 0 to 1. It used to be no securities. Now they issue new securities. Okay, issue new securities. From 0 to 1. This company is a private company. Now they go public. Issue new stocks. This is the primary market. Okay, they issue new stocks. Everything is new. We call them, there is a term, is called IPO. Do you know what IPO is? IPO is initial public offering. Okay, initial public offering. When the company, they do initial public offering, that is a primary market. They issue new stocks. This company transfer from a private company to a public form. Initial public offering. I want you to remember this term, IPO. Okay, IPO is a good process to create millionaires and billionaires. Okay, let's say Facebook. You know Facebook? Do you have a Facebook account? Facebook do the IPO. One night, they create hundreds of millionaires. Okay, those people work for Facebook. Before that, going public, all those individuals, they have shares. Okay, that shares is not publicly traded. It's just a privately held. And then the company goes public. Okay, those shares can convert into cash. If you sell your shares, you can get cash. So those people become millionaires. Hundreds of people become millionaires immediately. That's how impressive, and why, you know, when you see the IPOs, the company's new issues, that's very exciting. Other than the IPO, I wanted you to remember another term. It's called SEO. Okay, SEO, seasonal equity offering. Seasonal equity offering. Okay, primary market including two. Okay, IPO and SEO. Okay, SEO is the company they already issued the stock. Okay, they already issued the first round of equities. They wanted to issue more stock. Okay, they do second round, is still new securities, but they do more. So that is called a seasonal equity offering. Okay, do you understand the difference between IPO and SEO now? Okay, IPO is from 0 to 1. SEO is from 1 to 2. Okay, they already have stocks, you want to issue more stock, but all that is still new securities. Okay, so that's a primary market. So, and okay, this process will be complete by investment bank. Okay, your company cannot do that. Even you wanted to issue stock, Facebook will not do that. Facebook will ask a investment bank to help to issue new stock. So all those process goes into public will be complete by investment bank. So, and later on we talk about that. Investment bank will now do this for free. Okay, they charge you money. Okay, it costs a lot of money. Okay, on average, in the United States, it's 7%. Okay, you raise $100, you have to give 7%, $7 to the investment bank. Okay, depending on the size, sometimes even higher. 7% goes to the investment bank. That's why you can see those big banks, they have good environment, good location, and tall buildings, and their employees, they pay good. That's why they got money from, okay? Primary market is from 0 to 1, IPO, or 1 to 2, SEO, seasonal equity offering. What is the secondary market? So secondary market is that stocks already issued, okay? Stocks already issued, and trade between different investors. Trade between different investors. Okay. So that is a secondary market. So what's your name? Carlos? And what's your name? Okay. Tiffany? Okay, Anthony. Okay. Anthony has a Facebook stock. She wants to sell it to Carlos. And you buy the stock from her. That is a secondary market. Okay, there is no new stock issue. It's just the stock transfer ownership from Anthony to Carlos. That's it. So that's a secondary market. Secondary market is that investors only trade previously issued securities, okay, with each other. The total amount of those securities is still the same. Okay, we call them outstanding balance. Okay, outstanding balance of the shares is still the same amount. It's just from Anthony to Carlos. Okay, that's the secondary market. Okay, you can see the fund from one to another. Okay, there is no new issues, no new stocks issue. Okay, financial market could be money market and capital market. So what is a money market? Money markets are short-term, okay? Short-term instruments, okay, less than 1 year. They have expiration date in 1 year. Okay, expiration date in 1 year, less than 12 months. That's a money market. So money market, typically we talk about is T-bills, commercial papers, and CDs. Those are in short term. And comparing to money markets, we have capital market. So the capital market is a long term, which going to trade long-term securities. It's going to trade long-term securities. So we call them capital market. So namely, the capital market including bond and stock. Okay, that's the two, bonds and stock. You could invest in either bond or stock, or you do a portfolio investment in both bonds and stock. Okay, that's a capital market. There are something derived from the capital market. It's called derivatives. The derivatives is derived from the bond or stock or foreign exchange or something derived from those underlying securities is called derivatives market. Is also considered to be capital market. So capital market in general is much broader and much bigger. Okay. So when you're talking about the capital market, you can trade those securities on official exchange. Official exchanges like New York Stock Exchange, American Exchange, NASDAQ. They have official exchanges, or you just do the over the counter. Okay, no official exchange. It's called OTC. OTC market is not officially traded. but they have over the counter, okay, OTC market. So OTC market is much bigger, okay, comparing to that officially traded in that exchanges. Okay, as what we have mentioned, that intermediaries going to be the third party will facilitate those transactions to help the flow of funds between different economic units. So those intermediaries, we're going to talk about and with more details in next chapter. Intermediaries, think about is more likely we'll talk about is like a commercial banks, a credit union, saving and loans, and insurance companies, pension fund. Those, all of them are called intermediaries. Okay, the third party. Okay. Any questions? We're gonna skip this market efficiency because we have to spend a lot more time to work on the market efficiency. Okay, and later on I will talk about market efficiency. Okay, the securities in financial market. Okay, this is the one we called money market securities. Money market is securities, including high treasury bills. Okay, it's called T-bills. Okay, T-bills. The T-bills is only 3 months, 6 months, or 9 months. Okay, no more than 12 months. Treasury bills is the short term that's issued by the federal government. That's called the T-bills. Whenever you see that is treasury something, okay, is issued by the federal government, Federal government, they have 3 different type of securities issued. Okay, T-bills. T-bills, 3 months, 6 months, 9 months, short term, no more than 1 year. Treasury notes is also issued by the federal government, 1 to 5 years maturity. Okay, the second time. Okay, treasury bills, treasury notes, 1 to 5 years. Treasury bonds, 10 years, 30 years. Okay, that's the longest one. Okay, federal government issue 3 different types of the securities: T-bills, T-notes, and T-bonds. Okay, the T-bonds is longer, 10 years, 30 years. Okay, so sometimes the student says, okay, they issue T-bond. T-bonds, it's T-bonds. Okay, T-bonds is not T-bonds. My students are answer that question on the exam, and he wrote that as T-bonds. I said, do you have a pad at home? So always think about T-bonds. T-bonds, okay. Certificate of deposits, CDs. This is short term. So sometimes you got money, but you wanted to have a higher interest rate. You can go to the bank. They ask, do you have CDs? Do you have CDs? Okay, the CDs is that when you buy the CDs, typically at the minimum is 1 CD is 5,000, and the 2 CDs 10,000, and you have to put there for 6 months. give you higher interest rate. A longer time period, you have to put in your investment. It's called CDs. Okay, certificate of deposit. Okay, this CD is not that CD. You play music on. Okay, it's not related to your past. It's not to the music. But I wanted you, to memorize those terms in finance. Okay. Commercial paper. Okay, we're gonna combine commercial paper and banker's acceptance. Okay. Commercial paper and the banker's acceptance are the same. They both code IOU. Okay, using English letters IOU. Okay, IOU. IOU, that means I borrow the money from you and I promise I'm gonna pay. Okay, that's right. I write a piece of paper. Okay. So I write a piece of paper to Carlos. Say I owe you 5,000 US dollars. Then I sign my name on there, put my signature and the date. Okay, Carlos bring that piece of paper and to my dean and says, hey, this is Roy, I have his promissory notes, 5,000. Can you give me $4,000? The dean said, hey, it's not fine. I know him. He's a pretty good guy. He has money paid by HR, and so I'm pretty good. So he give you $4,000 because I signed in there. And I have my signatures. I promise I pay you $5,000. Okay. But most of the time, how about you bring that piece of paper to Anthony? And Anthony say, oh, who is that guy? I signed that name, just a piece of junk and put it in the trash. He said, no, I don't want to give you money. Even that's $5,000. I don't know who is Roy, So that's the thing. It's very important who signed that piece of paper, okay? The commercial paper is signed by the company, okay? Signed by ExxonMobil. For example, you got a piece of paper, okay, Carlos says, okay, this piece of paper is a promissory note, and they have a seal or signature of ExxonMobil. Their president signed there. That's a commercial paper. Can you sell that? Yes, a lot of more people will accept that. They see the signature of the president of ExxonMobil. That's pretty trustworthy. Okay, signed by the company. It's a commercial paper. What about signed by the bank? The banker's acceptance, if that paper is signed by the bank, okay, it's signed by JP Morgan. Okay, it's gonna be pretty trustworthy, even more trustworthy because this is signed by the bank. Okay, that is called banker's acceptance. Okay, both of them is IOU. Letter I, letter O, letter U. Okay, IOUs are promissory notes, commercial paper signed by the company, and banker's acceptance signed by the bank. Okay, so they are pretty trustworthy and is circulable in the financial market. Okay, any questions about this too? What about euro dollar? What is euro dollar? Okay, euro dollar is euro or that's dollar? Okay, it is US dollar. Okay, euro dollar the US dollar deposits overseas. It's a short term. Euro dollar are the dollar in the banks located outside of the United States. Okay, euro dollar. Why this is euro dollar? Because historically, in World War II, US is the winner of World War II, and plus US got a lot of money from World War I, so the huge tons of money in the United States. And the United States don't know how to use it. So they, say, now the euro. How about we just, develop these countries uses money in euro. So that's the Marshall Plan. They spend money, a lot of money in Europe. That's why the US dollar goes to Europe. So based on that, because of that history, so that's why it's still called euro dollar. Okay, those dollars goes outside of the United States and stay in Europe. Okay, the following several slides are talking about the instruments with more definitions. So I just wanted you have to read that by yourself. Okay, negotiable CDs, treasury bills, commercial paper, euro dollar, bankers acceptance. Okay, that's money market. Talking about the money market, now we are going to talk about the security market, the capital market. So the capital market, you have bonds. Okay, the bonds issued by the borrower and sold to public investors. The bond, they promise they're gonna pay the fixed amount on that maturity date, and also they pay interest. Okay, also pay interest. So the bond, if the issuer now going to default, so you will get the face value plus interest. Plus interest. So we call those bond is a fixed income securities. Okay. Another textbook, and when they talk about what is a fixed income securities, okay, this is mainly talking about bonds. Okay, bonds is a fixed income securities. Okay, they give you fixed income. The interest rate or the interest is already determined. It's written on that contract. Okay, so the bond has to mention when there's going to be the maturity date and what will be the face value and what will be the coupon rate. So the coupon is the interest you will receive from buying that bond. Okay, later on we have one chapter is talking about how to calculate the bond price. Okay, using the face value, the maturity date, and the coupon rate. So interest rate is determined by the market. Okay, so you might have to looking at the coupon. Okay, the coupon is the interest. The bond could be issued by the federal government. We call them as a treasury bond. Okay, talking about T-bills, T-notes, and T-bond issued by the federal government. What about the municipal bonds? Municipal bonds issued by the state and the local government. For example, like Texas, they issue bonds. Houston, city of Houston, issue bond. All those are called municipal bonds. Municipal bonds issued by state or local government. Okay, one thing I want you to put in there is the municipal bond is a tax exempt. Is a tax exempt. Okay, if you buy federal government bond, the treasury bond, you receive interest, you will pay tax on that interest. But if you receive interest of buying municipal bond, you don't have to pay tax on municipal bond. Okay, municipal bond is tax exempt or tax free. Okay, that's the benefit of buying municipal bond. Okay, how do you pay for it? The federal government will pay using their tax. Okay, so the government issue more bonds, the more tax you for U.S. citizens gonna pay. The state government, we have two different types of municipal bond. One is called a general obligation bond. Okay, it's called a GO bond. So this one could be GO bond. The GO bond is called a general obligation bond. So we have quizzes on general obligation bond. Okay, so it's not here. You couldn't see it here, but you do have this type of question in your quizzes. GO bond will be paid by the tax we collected, and the state government will collect the tax to pay for that GO bond. Okay, it's a general obligation bond. Another type of bond, municipal bond, is called a revenue bond. Okay, revenue bond is also municipal bond, but they paid by usage. For example, like Houston, we have tollway, right? The tollway, they issue bond to build a tollway, and they pay back by the toll. They collected tolls to pay the money they borrowed to build that highway. It's called a revenue bond. Corporate bond issued by corporation. A corporate bond issued by company. Okay, the company issue bond and also issues stocks. Okay, that's the stocks including common stocks and preferred stock. Okay, the common stocks will pay dividend. Okay, common stocks holders will get a benefit from investing those common stocks by getting dividend. Okay, so why you buy common stock? Okay, two reasons. One, common stocks has ownership. Okay, the more shares you have, the more ownership you have in that company. So common shares is a representative of your ownership. Okay, your ownership. That's why common stock is different from preferred stock. Common stock has ownership, preferred stock does not. Okay. And a common stock could have voting right. You can vote to fire that manager, or you wanted to vote on the major decisions, but the preferred stock, no. Okay, so basically That's the benefit of common stock. Common stock could pay much higher dividend than preferred stock, but it could be nothing. So that's a common stock. Preferred stock, why this is preferred? Okay, preferred doesn't mean ownership. Doesn't mean ownership. It's just to receive the dividend is fixed. Okay, so I wanted to say you wanted to add a word here, but have priority in receiving fixed dividend. Okay, that dividend is fixed. So at the time you purchase preferred stock, the dividend is already set. Okay, the company become pretty good performance, your dividend will not change. The company lose money, your dividend not change, is fixed. Preferred stockholder will get right to claim the residues if the company bankrupt before common stockholders. If the company bankrupt, the preferred stockholder will be paid before common stockholders. Okay. Yes.
So in that case, would there ever be a scenario where, like, due to limited funds, a preferred stockholder would get paid and there wouldn't be any left for a common stockholder?
Yeah, could happen. Yeah. And, you know, that depends. So, you know, sometimes when the company is bankrupt, and then they have something left. The first they gotta have to pay is their employee. So the employee will get their salaries and paid off. And then they have debt, they pay off their debt, or the government tax. Those things have to pay off first, and then it goes to the debt collector. And then after that, you go to stock, okay? The stock, you have preferred stockholders and a common stockholder. So they pay preferred stockholders first, and the last goes to common stockholders. And yeah, could be the case you talk about, but more likely when they bankrupt, you know, nothing. Okay, even the preferred stock is before the common stockholders, and it's a very tiny chance they got something. Because before the preferred stock, they have also some debt collectors, okay, different types. And so I wanted to talk about the market efficiency. Okay, this is the most important concept. Okay, this is the. Let me see. Okay, so the market efficiency is called efficient market hypothesis. Okay, efficient market hypothesis. So when you talk about this thing as a hypothesis, that means it's an assumption. So you assume that market is efficient. Okay, you assume that market is efficient. So what is an efficient market? Why the market is efficient? Okay, so we're gonna talk about, so efficient, that means there are some information coming to the market. The price will reflect that information. But because of this efficient market hypothesis, I would like you to see there are, this is a 3 Nobel Prize winner in economics in year 2013. Okay, 2013 is, we have a 3 finance professor got a Nobel Prize. And this is the first one is Dr. Farmer. Okay, Dr. Farmer talking about 3 forms of market efficiency. 3 forms of market efficiency. You know, he did quite a lot of empirical study, you know, for many years. And a lot of people say, hey, Farmer is supposed to get a Nobel Prize because his, you know, his significant contribution in finance. He did quite a lot of, you know, important thing, but most of the time he did that is empirical. He didn't have much, you know, strong theory. You know, one of them is called market efficiency hypothesis. Okay, so he got a Nobel Prize finally in year 2013. So you can see that's him. The other 2, you know, also very important. So I want to talk about later. Okay, just I want to know the efficient market hypothesis is came from a Farmer, and he has another co-author is French. Okay, Farmer and French. So, but okay, this is the this is him. Okay, we'll talk about that. Okay, talk about the market efficiency. I wanted you to know what exactly is that. So market efficiency says the price of investment reflect existing information and adjust quickly when new information enters the market. Okay, so sometimes we say US market is good because it's efficient. The price reflect the information. If it's bad news or good news, the price will adjust to it immediately. Okay, some of the country, their stock market is not efficient because the price will not truly reflect those information. Okay, he said there are 3 different forms of market efficiency. Okay, 3 different forms of market efficiency. And the middle part is a weak form. Weak form. The weak form market efficiency says stock price already reflect all information contained in history of trading. In history of trading is like a historical price, historical trading information. Okay, that's a weak form. Okay, weak form give you an implication is that you can just look at the historical price to make money. When you look at the historical trading volume, you can make money. Okay, someone tell you to buy a stock analysis software, you can make money. That's a weak form market efficiency hypothesis. Okay, if that is true, using that software is just a waste of your money. Semi-strong form market efficiency is that stock price already reflect all public information. All public information. Okay, those are public information including the financial statement. So every firms have to publicly release their financial statement, mergers, acquisition information, the change management, they do project investment, all those information will be reflected The stock price already reflected. The company, they have earning projects, the stock price already adjusted for it. Okay, that's a semi-strong form. The strong form says stock price reflect all the information, private and public. Okay, private and public. Even private information is already reflected. So you hear someone, for example, like ExxonMobil, their president tell you, okay, they're gonna have a very good project, earning tons of money, and then he tell you, and the following day you purchase ExxonMobil, and the price jumped up, you made money. Okay, that is strong form. The strong form says reflect all the information. Even you got a private information, it's already reflected in that price. So you cannot make money. That's a strong form. Okay, so the weak form, let's go here. So weak form, if the weak form efficiency is true, the price already reflected all the historical information. So can you do technical analysis to make money? Okay, that's the question. You know, a lot of students, they make a program and in computer using Python or using C, or maybe whatever, Java, then they make a program, they tell you they can make money. Okay, that's all the things, technical analysis. That's a technical analysis. So a lot of companies, they sell software is based on the weak form market efficiency because they don't believe that is true. So that's a technical analysis. Okay, technical analysis is based on the historical price and the trading information. Okay, so what is the stock price, you know, really looks like? This one is called a random walk. So think about, you know, you drink a lot of beer and then you got drunk. So you don't know where you're gonna go, right? So it's basically, the stock price is a random walk, okay? That's empirically a lot of people say. If you use the historical price, the price of the yesterday and the week before to predict what's going on tomorrow, can you make money? Use the price, historical price. What do you think? Okay, not really. Okay, you agree, that means you don't believe weak form market efficiency is true. Okay, because you think, oh, the stock price is just randomly, you know, it's hard to predict. Even you have the historical price, yesterday's price, you cannot predict future. You cannot. So that's a lot of people believe. Okay, you can say, okay, I don't believe that. You still buy software. That's up to you. Okay. And there another thing that's about the technical analysis. There is a professor, you know, he did that experiment. And so as one is his student, his PhD student, and to using the software and the chart to make a decision, suppose buy and sell stock for 6 months during that particular period. And another, he just got a dart, used the chimpanzee to flip the dart, and they got into the target, they buy, and then they didn't get in there, just sell. Okay, who gonna win? Do you believe his student gonna win or the champion league? Okay, after 6 months, okay, actually, his student cannot beat the champion league. So that means, you know, the technical analysis is not valid. So the stock price is just random. So that's another experiment. Okay, so now we go to the fundamental analysis. Okay, fundamental analysis is related to Siemens strong form efficiency. Okay, can you use the financial statement, the public financial statement, to make a decision of your investment in that company? You know, you read those financial statements and to decide you should buy the stock from that company or not. What do you say? You do fundamental analysis. How do you think? Yes. What about Ethnic? Yes. Okay. That's why you spend money to study finance or accounting. So the Siemens strong form says, okay, we have to do some fundamental analysis before we invest in stock. That's what a lot of people do, okay? And, okay, half, you know, some of the people they believe, some of the people they don't believe. But, you know, they do some evidence they support. If you read those financial statements and you do a deep analysis, they can help you to make more money. Okay, so one of them is called Buffett, Warren Buffett. Do you know Warren Buffett? Yeah, he's a billionaire number 1 or 2. You know, he has tons of money. Okay, very rich guy, number 1 or 2 around the world. Okay, another thing is that Warren Buffett, he's the only one become rich by doing finance. Okay, he does not have any business, real business. You know, those other people, they have their own business. Like a Microsoft, they do have Microsoft, that products. Warren Buffett is the only one that has nothing. He only do finance. You know, he's the one doing, he already says, okay, we have to do fundamental analysis before investment. So if you wanted to eat lunch with him, do you know how much that cost? Okay. So last year he has the auction. It's 170 million. It's 1,700,000. So this cost that much money to just eat lunch with him. So every year, it's just a hamburger. Okay. So that's he's very famous because of the, you know, like he's told people, investors, you need to do fundamental analysis. You know, this year he lost a lot of money in his investment in the airline. So he invested a lot of money in United Airlines, American Airlines, but he didn't know that is the pandemic here. You know, he lost a lot of money. He sold out to those airline stocks, lost the 40 billion or something, a lot. But he's still rich. You know, he got a lot of money from different areas. And so there are a lot of tests, okay, for that fundamental analysis. Like this is Siemens strong form. And also we have strong form. Okay, strong form is that if you get information, private information, and you make a profit, okay, that's a strong form. Strong form says the stock price reflect all the public information and the private information. Okay, and that's all the people, all they disagree. Okay, if you have private information, you can make money. That's why the law and regulation says you cannot do that. Okay, if you have you do insider trading. Insider trading, you know what insider trading is? You know private information you're starting to invest in that stock. Okay, if you were caught, you will be put in jail. Not only the penalty, also you put in jail. So that's why the strong for market efficiency, a lot of people they don't agree. Okay, if you do have private information, you can make more money. And I have a lot of cases you want to Google or search about insider trading. Okay, insider trading is that if you do that, you will be put in jail. Okay, do not do insider trading. Do not do insider trading. You know, some of the students in my previous class, he said, I want to take a chance of it. You know, nobody knows. You know, only God knows. You know, I know. Nobody knows. I just take that information and to make money. Okay, and later on was find it out. You know, the SEC, FBI will come to you and knock your door. They will find out. Okay, and so the one of my friends, you know, is Yefei, and Yefei is one of my friends. I know him when I was in master degree. He's my classmate, and he got to he's in MIT, a very smart guy, and he was caught doing insider trading. And his wife is a very famous lawyer, and is dealing with the contract of that company. He know that his wife know that contract, and tell him, so that company will going to have a big project, very good project in Africa. They're gonna make tons of money. So he's starting to purchase a stock of that company. And later on, FBI coming to him and to check, you know, he said, how the FBI find he's doing insider trading. You know, he Googled something online. He Googled, okay, what is the punishment of insider trading on internet? They'll say, whatever you do, all that information, FBI knows. They know what you're doing. Even you work on your own computer, they can find out that clue. Okay, find out that. So he, at the beginning, FBI asked him, he declined. He said, no, I just normal. I just invest in a company. I don't know nothing about it. And later on, FBI showed that evidence. Okay, so you can be careful with that insider trading. Okay, I think that's all for today. So as the time is up, so we are going to stop here. Any questions? Okay.